I know it's a horrible, I'll say it, very shitty market. 8 straight down weeks. Most of your portfolios, including mine, take it on the chin. And during times like this, we want to be there for you. Try to help you out. We've seen these types of markets before. We've seen 1987, we've seen it in 2000, 2008, and 2020, and almost every single time those pullbacks turn out to be big buying opportunities. Almost all the time. If you look at the long-term chart of the S&P 500 since the 1950s, since it became 500 companies, I know it's hard to see now, and some people are predicting the worst, especially bears and those perma bears. Just like perma bulls, right? When you have perma bear and the market goes down 30%, they think it's going to go down another 60% from there. They're never satisfied. Just like perma bulls goes higher and they keep raising, higher. They never say, okay, that's it, right? They never flip. They don't. It's just a state of mind that could be very, very dangerous because you're not changing with the times or the data. And that's where it gets dangerous. Right now, a lot of the risks we know, I will not cover them. You can listen to my past 50 podcasts over the past 7 or 8 months. I know all the risks out there, but a lot of those are being priced in because we're talking about them a lot. Plus, the Nasdaq's down 26% from its highs. The Russell S&P 500 down around 20%, meaning a lot of the negatives being priced in. And sure, we can go lower from here. It's going to be volatile. There's a lot of names, industry-leading companies. Over 125 of them trading below 10 times forward earnings. Average healthcare stock down over 75% from their highs. Are they all shitty? Absolutely not. Could they go lower? A little bit. The best names are going to bounce back. A lot of great names out there trading insanely cheap valuations with good growth profiles right now that anyone with the 18-month plus time horizon should be pretty excited. Should be picking away here and there. We did see a nice rally on Monday. Dow surging 600 points, Nasdaq rallying 1.6%, the S&P 500 jumping 2%, coming out of bear market territory, which means absolutely nothing. But it makes for a nice headline. I don't think people feel any better being down 21% as opposed to being down 19% from the highs. It's kind of like, are we in a recession or aren't we in a recession? Who cares? Do we need to know? Like, do we need to label it? You're getting your ass kicked. People get an ass kicked. Asset prices are coming down. See so many stocks getting nailed, especially through earnings season. With that said, there's definitely some positives. The 10-year's been holding steady under 3%. That's great. It's great news. Over 3% gets very, very scary. Now it's holding. That's what we want to see. We want to see a top in all the negative. And inflation, right? We want to see that start moderating, which we're going to see based on what Target said, what Walmart said, what a lot of these companies are saying, especially over the last month. People are just stopping spending. They're not spending. Out of nowhere. Got oil prices around 110 yesterday high. Hopefully they go lower from there, but we just don't want to see them go much higher from there either. But natural gas is still a major headwind. I mean, it popped 8% on Monday. Well over $8. I mean, that's a major cost component for chemicals, plastics. I mean, so many different things. Fertilizer, you have no idea. No idea when it comes to natural gas. I mean, products use natural gas, and that cost goes higher and higher and higher. But even after yesterday's gains, Dow Jones Industrial Average, year-to-date, down 12%. S&P 500, year-to-date, down 17%. Okay, these are year-to-date, not off their highs. Russell 2000 down 20% year to date. Nasdaq is down 26% year to date. Just in May, 26% in Nasdaq. That's an incredible move. Unbelievable. And what do we see after the close? Right? So I highlighted some positives, but what do we see after the close? Another company getting wrecked after reporting earnings on Monday, which is Snap. They bombed its earnings. Projected EBITDA, you keep your score at home, earnings for interest, tax, depreciation, amortization. It's a better measure than just pure earnings. And a lot of companies that are reporting losses like to use EBITDA because it's going to show, before all the garbage, all the expense, all the craziness, it's going to be a much better number than earnings sometimes. Anyway, but Snap projected EBITDA to be between 0 and 50 million, right? That's what they said last quarter of what's going to be, between 0 and 50 million, profitable. And now it says it's going to be below. I don't mean to laugh, especially if you own the stock, because it's down 30%. But the CEO said It's now expecting it's going to be below the low end of this guidance. I mean, what's lower than 0, right? So I just like the way he put that. I said, hey, we're going to lose money instead of making money. But, I guess he tried to sugarcoat it. Maybe it resulted in a couple, instead of being down 35%, you're only down 30%. I have no idea. But Snap's getting wrecked. Along with Meta, the old Facebook, Twitter, the Trade Desk, social media advertising companies getting nailed after this report. And what did the CEO of Snap say? He said the same thing Walmart and Target said last week. And usually companies in between earnings, they warn. They're like, holy cow, this is going to be a shitty quarter. We're going to warn and say we're going to miss estimates. And usually they provide estimates that they lowball it. This way they beat it when they come out the quarter. But the stock usually gets hit and get hit 10, 15% depending on what it was. Or what their guidance is. These companies did not warn because the downturn happened so quick. That's what Snap said. The same thing with Walmart and Target. Same exact thing. These guys didn't get a chance to. It was like the last month of that quarter, and whoa, what the hell just happened? Which is saying what's going to happen to the rest of the companies that are reporting, because that's one of the things that sucks about this market. You can go picking away. Don't pick away at any company that hasn't reported earnings. I think it's around 90-something% that reported. There's still a lot of. Not a lot, but a few big names that report. You got Best Buy reporting small. You got discretionary names. So after the close, and I don't want to scare the shit out of you if you own these, but Nordstrom, Urban Outfitters, Toll Brothers are reporting. Toll Brothers gives good indication on the market. And what do we see? Especially with these retailers. If they don't meet the numbers or they report bad earnings, these things get destroyed. I mean, everybody runs to the exit. It's not like, wow, this thing sold off too much and let's buy it back here. It's down 20%. The next day, it goes down another 10%. I mean, they get annihilated. Annihilated if they don't put up that number. TJ Maxx put up a good number. But most of these guys aren't putting up good numbers. Because later in the week, what do we have? Alibaba, Macy's, Dollar Tree, Dollar General, Burlington stores. I mean, I'd be scared shit to own those in my portfolio right now. Forget about if they're down already or it doesn't really matter. But if these companies come in, because most of these estimates have been lowered going to the quarter, but just to see the significance of what has changed over the past month, and if these companies see any of that, where they're going to report massive declines and they're going to be way off and miss estimates by a mile, you're going to see another 20, 25% decline. So be very careful. Very, very careful. That's the negative. That's what sucks about this market. Because if any of these names beat, what are you going to see? Depending on what the market conditions are that day and how much it's up, maybe see a 5%, 7% move higher. If they miss, 25, 30, 40% gone. Boom. Look at Target. Target's a great company, a great name that's gotten it done. 25%, boom, in a blink of an eye. Thinking that you're safe. It's Target. I love to go there. It's awesome. Take my kids there. We buy stuff all the time. Where the hell did that come from? That's what happens in a bear market. Especially one that has this much leverage in it, where trillions of dollars need to come out of the system. And that's what you're seeing right now. You're going to see forced selling. People being forced to sell even their good names. Maybe they're nervous. Maybe they're on margin. A lot of these hedge funds are leveraged death. You'll see a lot of blowouts. And probably seen them right now. That creates unbelievable buying opportunities for people who have time horizons past 12, 18 months. Again, it's going to be ugly, but when you've seen the NASDAQ down 26% from its highs, look, we're close. There are positives here. But again, you have to be careful, know the markets, and don't be all in.